Welcome, everybody, to the Everyday Investor Podcast. My name is Darcy Angaro, and today I'm catching up with Paul Quickenden from Easy Crypto. Paul, how are you?
Good morning, Darcy. I'm really well, thanks.
Now, there's a lot of 2024 has been a really interesting year, right? With the Bitcoin ETFs being launched early this year. Just to start off with, what is your take on the Bitcoin exchange traded funds? Were you kind of expecting to see that things would pass no problem? Or were you kind of one of the ones on the sideline wondering if it would actually happen?
I think it was widely signaled. There was a kind of a group of ETF analysts in the big companies like Bloomberg who were tracking all of the permissions and all of the denials. It was clearly lining up for around this early mid-January period. And so we fully expected that they would be approved. There was just so little reasons for the SEC to deny it that it kind of felt like it would happen this time. I think it's fair to say, though, we've been surprised. Like, we were bullish, but we were surprised, but just how bullish it's been in the take-up. And like the rest of the market, it's it's been an impressive launch, I think.
And so as we get into this, I want people to feel kind of like they can catch up with what the conversation is around Bitcoin, because I sense that this year in particular, there's going to be a lot of people that have been sitting on the sidelines for quite a while wanting to get involved with Bitcoin. So just to help those people out to understand where Bitcoin sits in the world of investing, what is your general definition of Bitcoin? Like not your elevator pitch, but if somebody asks you what Bitcoin is, what is your simplest answer that you could give?
Yeah, look, I view it as a digitized store of value. So kind of, and it plays a similar but not directly comparable role to gold in some people's portfolios. And what I mean by that is it's definitely an asset that's still growing in price, whereas gold, in my opinion, is quite a flat thing. But it's less about doing things with it. Like, Bitcoin evolved from being a person-to-person payment network or electronic cash, I think it was in the original white paper, to being this kind of person-to-person store of value aspect. And that's how I view it. There are a lot of different definitions. There's probably half the crypto community that are offended by that definition that I've just put out, but that's kind of how I view it.
No, that's a good way of putting it. So it's kind of like gold to silver, right? You'd spend your silver to buy the bread, but you'd use your gold to buy the bakery. And maybe if we follow that through into the digital asset universe, you think that Bitcoin will kind of be used as your base of wealth or your equity, and then maybe other crypto assets around the edges will be really what you use for the utility, or for even the utility of having transactions?
Yeah, look, there's a well-known cycle that happens within the cryptocurrency space, which is called the altcoin cycle. And typically it follows a pattern of one of the majors, so Bitcoin or Ethereum or whatever it is, goes really well. And then people take profits from that and invest into higher returning speculative assets, and those, because of supply and demand, go up, and then they reinvest back into the major coins, which remarkably are more stable or less volatile than some of the other stuff. And so that's well understood and well documented. And I think this time around, this cycle, Bitcoin is leading. It's up something like 67% in the first quarter. Other assets are doing pretty well, like Ethereum, I think, was up about 50, but Bitcoin is definitely leading out this charge this time around.
There's this whole thing with supply and demand, I think, which is kind of fundamental to this whole concept of Bitcoin, right? Which we don't really appreciate the basic forces of supply and demand when it comes to a lot of the investing world, partly because the unit of currency which denominates all of our traditional investments is something that can be artificially pumped and contracted as well in terms of its supply. So that naturally creates this distortion when we look at price signals. We don't really understand what's going on, because not only is there increasing supply and demand for, say, MicroStrategy or Tesla or Apple or Google, but there's also other forces going on with supply and demand in terms of the actual underlying currency itself. Yeah. And so it creates this really weird sort of noise out there in the market. And as it relates to Bitcoin, do you feel like what we're seeing in terms of the price run up says more about the underlying currency that kind of still denominates it in our head, i.e. the US dollar? Or is there really fundamentally a supply a demand thing that's going on right now where people are getting more aware of it and they're piling in?
I think it's both. And I think we've got evidence to support that statement. And so prior to Bitcoin hitting its all-time high price in US dollars, there are a lot of countries, and New Zealand included, where it hit its all-time high in the non-US currency. And that was because of the depreciation of the value that we could buy from our own base currencies like New Zealand dollars. And so that certainly happened. Like how we're mentally pegging access as being to the cryptocurrency is being affected by, more money coming into the system. And that happened, in 2021 and 2022 probably, and it's just flowed through. At the same time, all of the metrics that analysts track in terms of, the search terms for Bitcoin, the number of new wallets being activated, new customers coming in, all of that stuff are showing that there is a rise of new buyers coming in, both in the ETF space, which is another access to the coin, and in kind of the more native cryptocurrency space. So there is both trends going on at the same time. That's led to this really interesting situation where, we're now into our fourth cycle, halving cycle, and I think we'll talk about that a little bit later in the pod. But this is the first time ever we've hit an all-time high price in US dollars before the Bitcoin halving, which is only a few days away now, Darcy. So we are in new virgin territory, I guess. And so that's the inevitable question: is this cycle different from everything else? I guess.
Yeah, it's probably always different every time around, but the results are sometimes the same.
Well, they definitely rhyme. And, there are people who just keep mapping cycles over cycles over cycles, and they are rhyming. It's just slightly different entry coming halving this time. Yeah.
So custody, just again, for those who don't understand what this word custody means in the context of Bitcoin, this is important when we kind of frame up the discussion around Bitcoin ETFs or holding Bitcoin directly on your own wallet. What is the difference between, say, a custodial versus a non-custodial solution as it relates to Bitcoin?
Well, one of the key inventions that came along with Bitcoin was enabling me to look after my own wealth. So I'm in charge. I'm the bank. I'm hanging on to it, and I hang on to it in this thing that you just described as a wallet, which is the keys to unlocking my coins. That's how I view it. And great power, great responsibility, great freedom. I can transact anytime I want. The networks run 24/7. I can do that. And I'm in charge of that. And as long as I've got good understanding of the technology and I've got good security processes, that will work. Whereas the custodial way has traditionally been Bitcoin sitting on crypto exchanges. And now we're talking about ETFs buying Bitcoins and storing them on a custodian. And the predominant custodian, so the single point of risk now, is Coinbase, which is the most used custodian for all of those ETFs at the moment.
So custodial means that somebody else is taking care of it on my behalf, like with these exchange traded funds. If I decided to ape into this, one of the many Bitcoin ETFs that are now available, if I decided to do that, then I'm taking a little bit of risk that somebody else can take care of the custody solution really well, or as good as me, or ideally better than me, right? Whereas with the other option, non-custodial, I'm kind of relying on my own ability. So it's either my hands that I need to worry about or somebody else's hands that I need to worry about. Is that right?
Yeah. Like there's a trusted third party in the middle hanging on to your assets versus you're in charge of it and you're hanging on to your assets. When there's a third party, there needs to be profit involved, so there's fees associated with that. In our world, there's a heavy degree of trust because, the history of security incidents in crypto are largely related to having a third party in the middle, whether it's a custodian or an exchange or something like that. That's where the risk always seems to lie.
And because I guess we have this trusted wrapper of the exchange traded fund that we've seen wrap up a lot of other assets and diversified buckets of assets in the past, I guess there's a certain degree of faith in the system that these exchange traded funds won't let us down as it relates to Bitcoin, because effectively they have one job to do, right? They just need to acquire Bitcoin, hang on to it really safely, and that's it. Whereas with a lot of these other funds, it's all about portfolio rebalancing, and there's a whole bunch of other complexities as it relates to that. But with the Bitcoin ETF, effectively, it's like a commodity ETF, isn't it? Where
Yeah.
kind of there's not really a lot of risk in terms of the complexity, but you still have that kind of honeypot risk, don't you? Where there's this one place where all the coins are held. Do you think that represents an outsized risk that isn't really talked about enough? That's a bit of a leading question, isn't it?
Oh, look, it's certainly a risk. I don't know outsized, but it's indicative of anything that's kind of growing rapidly in a growth space. You'll always end up with one big controlling entity. That seems to happen across all industries, whether it's telecommunications, cloud computing, with Amazon, those types of organizations. You always end up in that market dynamic. Coinbase has a long history of doing really good stuff, but it does represent a risk. And that risk is if they get compromised, then, billions of dollars worth of Bitcoin get taken.
Correct.
And there's no untaking them. That's the problem with the cryptocurrency market. Yeah. In the banking and other ETFs, if there's another depository taking organization, for instance, the DTCC in the US, when they can go, no, that didn't happen, but in crypto, you can't do that. And then the other variable, like we talked about a year ago, I think, and there was an incident in a gold minting place in Australia, right? And they were holding gold for ETFs, but they were diluting the quality. It wasn't quite what everyone thought they were buying, right? And so because it happens behind closed doors, it's not quite as transparent as on the blockchain. And so that brings its own challenges, right? How do you know that Fidelity or BlackRock have bought 1,000 Bitcoin today? You don't know, really.
So, but we do have this choice now, which we didn't have this time last year, right? So now, being in New Zealand at least, we can jump onto our shares, these are Hatch or our Stake app, and we can find some of these Bitcoin ETFs and we can buy it. Yeah, there's fees. Yes, we are taking some degree of risk with these other third parties to hold on to these coins really well, but I guess it affords us a certain degree of flexibility that we didn't have before in terms of rebalancing. Like if we did take a really serious long-term view of our Bitcoin allocation, for example, we might want to sell off a little bit when that allocation gets too high. And the less friction there is around that, the easier it is, I guess. So there's definitely some advantages, but I can also see some real hardcore advantages to just jumping onto a platform like Easy Crypto, for example. There's the plug. And just jump in there and buy some coins, send it to your wallet. There's a small fee right away, but then there's no ongoing fee. And you don't need to worry about any of that stuff because you are literally outside of the system. So for those that don't really understand or appreciate the difference of just owning that Bitcoin directly, the non-custodial solution, can you just give the lowdown in terms of the main benefits that you see around why people should still consider holding crypto directly?
Yeah, so there's a few. So one is timing. So if you're in an ETF, they're settling the next day, so or the day after if it's a weekend. So T+1, T+2 kind of settlement. So there are delays there. Whereas if you own the crypto asset directly, you can send it in minutes and have it processed. There's also a degree of portability. Like if you're invested in Sharesies here and you relocate to Australia, what happens then? I don't know, right? Different taxation rules, different whatever, different access rules. Whereas if you own if you still got the wallet, you just transport that wherever you want. And then finally, the big one for people who are into self-custody is there's no risk involved there. Like it's me, I'm in charge, I'm comfortable with that. And as I said, all of the major security incidents that have really affected the market have all been coming out of custodial solutions in crypto. And so not your keys, not your coins is a statement that's lived long and hard in our space for a long time. And it just means, you're taking that third party risk out of the equation. And like I said, there's in a third party arrangement there has to be profit. So there is some fee dilution in that space as well, right? And that's just kind of how those markets work. Like we're a non-custodial business. That's our favorite type of doing crypto. and we just believe that one's one of the big parts of the evolution of the financial market that blockchain's brought. And so we think that having that kind of control is just a much better place to be.
So going back to the supply and demand dynamics, I'm crossing my hands like a big X here to kind of signify the supply and the demand curve, which sets the price in a free market, right? So we have a unique asset in that Bitcoin is a finite asset. The supply cannot really be increased. And we do have a halving event that we'll get into shortly, where the supply of new Bitcoin is going down to 3.125, where the new supply of Bitcoin is decreasing by half. We still have a situation, though, where the demand curve is sliding up, which is pushing up the price. And there's two avenues now. Like we say, we have the custodial and the non-custodial demand that's entering into this fixed supply world. We probably need to talk about both of these things, right? Like, so firstly, with the exchange traded fund, I read recently that about $130 million of net inflow is kind of like more or less the wash, or it's just the rebalancing from one pile to another. But we've seen net inflows far in excess of $130 million consistently now, which seems to be having an effect. So looking forward this year, what are some of the things that you're kind of considering with the exchange traded funds in particular that could lead to increased demand throughout this year? Like, do you think what we've seen as much as we're going to see, or do you think that that's only going to increase as the year progresses?
Great question. So look, we should acknowledge the ETFs have been ridiculously successful. Like, they've been the fastest to 10 billion assets under management, like all of that stuff. They are outrageously successful. And I think I read a report, I think there's right now something like $60 billion US dollars of assets under management. And I actually don't know how many Bitcoins that are, but I think it's close to 1 million, right? It's a big number. And they've been accounting for roughly 7 to 8% of the total market volume has been the ETFs, and that's Bitcoin only. So they've been very successful. There are people who have been looking at this and they believe that even as successful as they have been, it's mainly been ma and pa buying through the ETFs or small investor groups, that sort of stuff. It hasn't been the really big, sovereign wealth funds, Canadian pension funds. There hasn't been that type of organization yet who have come in. And given that that really big institutional part of the market is trillions of dollars of assets, like that's where the BlackRocks and the Fidelities really make their money, we still think there's going to be a lot more demand coming in. The number of new wallets in the crypto space went up about 33% last year. We don't have this quarter's data, but I would suggest, just given by the trends in Bitcoin and the search terms, like we would have seen a bunch of new entrants come in. We're certainly seeing it on our platform. Like, there's a new wave of people coming into the space. So in terms of demand, we think it's there. We don't think it's been sated yet. We think there's more to come. That more to come will be, as these bigger investors start changing their investment mandate and getting access and putting a small allocation of Bitcoin into their funds and all that sort of stuff. Then supply. So Bitcoin has a finite supply cap of 21 million, but every day we add a little bit to the supply, but it's got a decreasing curve. So at the moment, we're adding around 900 Bitcoins a day from the mining activity into supply. That's about $63 million at today's prices, US, coming into the market. And those goes to the miners. The miners have bills to pay, so they sell that. That's kind of the activity that's going on. Around the 18th, 19th of April, that supply will halve. So rather than having 900 Bitcoins a day, we'll only have 450 Bitcoins a day. And not immediately, but what's seemed to have happened over the previous cycles is that creates a little bit of a supply shock in the market. Retail people who are holding them will fill some of that void, but people who are going, actually, I can see this going to X price, will hang on, and then the price goes up. My view is just about everybody's got a number, Darcy, and so, there'll be some theoretical levels where people will start selling out in bubbles. 100K is an obvious one, for instance. Everyone will go, yeehaw, and 100, and then there'll be other people who are hanging on for dear life till 300 or whatever the number is. It's just, they're big numbers. And then we'll see more supply coming in. But given that more demand, institutions, ETFs, and the retail users, because Bitcoin is now much more topical because of the price, and supply are halving, we think that dynamic, your supply and demand dynamic, will continue, and that normally leads to post-halving a rally in the Bitcoin price. That's what's happened the previous three cycles, and given more demand coming at it, it's a little hard for us to argue against it this time. Not financial advice, of course.
Both of them are pretty compelling, right? So both of those lines are moving up at the same time. The supply dropping by half, new supply dropping from 900 to 450, but also that demand. So going back to the demand side, we have these two avenues again, custodial, non-custodial. You've seen a 30% increase in wallets. You've seen turnover or transactions increase presumably as well. And then you mentioned that we haven't even seen the sovereign wealth funds allocate. We haven't seen central banks, publicly confess to allocating, but do you have a view on that?
Oh, look, there's rumors about central banks. There is a mystery buyer out there who's been buying 10,000 Bitcoins a day for about a year now. And no one knows who that is, but someone's guessing it's a sovereign wealth. So that's an interesting thing. So back to your question, when does the institutional money come in? At the time of launch, again, the ETFs analysts have looked at, there's hundreds of ETFs launched every year. And they talk about this kind of 3 to 6 month lag for institutionals to come into and get access to products. So we're probably still a quarter away from seeing that kind of change in behavior. So it's still something out there in the future that's going on. In the meantime, the analysis is pretty clear from people who look at this stuff in way more depth than me, that it's largely being driven by smaller investors. They can see that average check size is about 13K. That is not a sovereign wealth fund. That is people putting a degree of their life savings towards this stuff to help with their retirement and all that sort of stuff. That's how they kind of getting good indications and good data points that this has been driven by people that look a lot more like you and I than the faceless people in the big institutions.
So which force is going to win though, supply or demand? Like, this is the one thing that I keep on chewing over, because when I look at the past halving cycles, like you say, halving occurs 6 months, 12 months later, price goes bananas, and maybe some of that is just a supply scarcity gets people frothing at the mouth again and off they go, right? But this time around, the demand side is unusual. We've had all-time highs well before the halving, which breaks with the trend so far. We've never had an all-time high in the price of Bitcoin before a halving. Does that mean that it really is different this time? Does that mean that we should be expecting more or just more volatility? What does it say about what's coming next?
I think having institutional involvement will bring less volatility. They'd be more rational, I guess, is my view. It's much more, am I getting my alpha? Am I getting my beta and my returns? That sort of question. That's what they'll be asking. I think it's hard. The long run model that Satoshi Nakamoto created always said that this position would happen, that eventually supply would continue to decrease every 4 years, and we would end up with more and more wallets wanting it, and that would create this supply and demand imbalance, and that's how miners get paid. And if you're a miner sitting there earning 900 Bitcoins, per day, and there's a lot of miners, rough and ready, the mining community is earning 900 Bitcoins a day, and you turn around and say, hey, you're going to earn 450, then the price roughly has to double for them to be, at the same point the very next day. And I know you've got one of your guests who's a miner on your podcast, and he can talk to you way more than I. You can do a lot more in terms of efficiency and how you're producing Bitcoins and power and costs and all that sort of stuff. But that's the stark economic reality for those guys. And until that balancing happens, there will be a period of time where those guys are going to be hurting. And so they will do what they do. And they are arguably some of the larger holders of Bitcoin miners because they've been accumulating them for a long time. they will have to do what they do to manage price as well. And so it's a little hard to see that it won't happen again, Darcy. But I do wonder whether the classic 4-year cycle, where three boom years and one really bad winter year continues on, given we've got this institutional money coming in. Like I don't know, it could, in my mind, it could go either way more extreme as they exit out, going at the top, or it could be, no, we've got a much longer planning horizon, which is, 15, 20 years of super fun kind of retirement views, and we're just going to keep allocating a little bit every buying cycle, whatever their buying cycles are, towards this asset class, right? You just dollar cost average in and dollar cost average out as it goes up and down, and I think that's probably the more likely scenario.
I've been consuming a little bit of content just to help prepare for today, but also just it's been really interesting learning the different models that are out there to understand where price goes. And what's kind of refreshing about learning about Bitcoin is that when you are dealing with something which is mathematically designed to be a scarce digital asset, you can then start to reflect on traditional economic principles that actually work in a free market setting, because that's kind of when the rules aren't being changed all the time, you can kind of rely on that stuff again. And some of the models, though, are really interesting. Like I've spoken to some really smart people and understood a percentage of what they've said around what they see Bitcoin price, and I've been blown away by how wrong almost all of them have been in terms of predicting, hey, 200 grand by the end of this year. I think was one in 2021, which shall remain nameless, but I'll hopefully get him back on the podcast again soon. And the stock to flow one, right? Like I think it was Plan B stock to flow model didn't work. I was learning a little bit about the power law last night, or the power rule. Fred Krueger was the guy that I was listening to, and it was interesting because he shows that the price will either be this much or this much, but it's more of an upside gain than a downside loss, is what he was kind of implying with his model. And it's conservative because it was kind of implying that it would take a while, like maybe around 10 years before we'll hit 1 million per coin. But showing that, hey, if there's a 2 standard deviation move instead of 1 standard deviation, I know this is getting technical, but just Google Fred Krueger power law if anyone wants to learn more about this. But your general feeling, like if we're thinking, hey, 2030, what do you think could potentially happen in terms of the price? Are you bold enough to put a price target out there?
Wow, I'm not bold enough. Like it'll be more than it is now, Darcy. I have, all of those predictive tools, stock to flow, power law, corridors, pitchforks. There's a ton of them. They're all the best guys that I've seen using those use all of them. And if there's enough correlation, then they go, yes, that's kind of where I see this is going. And at the moment, there is enough correlation to say supply demand up and to the right. I would, they're very brave, those analysts, when they put out price predictions. There are numerous predictions. 200 seems to be the easy hit this cycle. Then you get to, Kathy Wood 500. Like they're very brave. I'm not an analyst, so I don't have a really good strong view on that, other than it will be higher than it is now. Like I really struggle to see that event not happening. Just because of the dynamic that is in place.
I think it's fair, isn't it? Like it's one thing to say that it will be worth a certain amount, but it's quite a different thing to say, well, what is that thing that you're translating it into worth as well? And there's 2 things going on right now. Like there is this growing revolution, I think it is, in terms of an alternative financial system that's happening, but there's also running parallel to that, a critical, I think, loss of faith starting to occur within traditional financial systems, which ultimately I think creates more monetary debasement, really, is where that goes. And so the denominator is getting diluted at the same time that the numerator is getting pumped. And that's the part that I think keeps on getting missed out of these models around where Bitcoin could be. Like a lot of the well, actually, the one that I kind of probably gravitate more towards is this correlation between the global liquidity versus everything else, because that seems to have been triggered. This Raoul Paul talks a lot about this, right? Where every 4 years you kind of see that the election cycle and everything seems to be correlated to this 4-year thing, and it just so happens that the Bitcoin halving is about 6 months prior to that, and so there is kind of that at play as well. And I just wonder, what impact that makes. Do you have any view on that?
I think it's both. Like, don't get me wrong, I really like his Rail's thinking, and he was the first guy who explained inflation to me in terms of the denominator online, and I was like, yeah, actually that mentally works for me. So I think it's both. Like, it's a little hard if with classic economic theory on to go. You got more buying power, so there's more liquidity, more money in the system sloshing around, and you got less supply. Those two things come together. That's just how economics work. Arguing one or the other is kind of seems a little bit irrelevant to my mind, because it's kind of like, well, supply and demand. That is the theory. It's both. Bitcoiners will argue it's always the supply, and he's saying no, there's an increased demand coming in, and so I think it's both. Like, I honestly think it's both. I don't know ultimately if we'll ever be able to find out, but there's certainly correlations between monetary supply, M2, I think it's global M2 is how he talks about it, and the price of Bitcoin. And they put out some really interesting newsletters every now and then, which are all free, and they can pre-predict stuff happening because of lags in the system. Like when you stop tightening, when there's a lag. We talk about it. You talk about it with the housing market. Like, there's always a lag between the New Zealand housing prices and what's happening with OCR, because we're all on fixed mortgages and all that sort of stuff. There has to be lags. So he's just done the work in that space. Upshot is, I think it's both. I do think more money helps people. I do think looser monetary conditions certainly make people skate towards assets that are delivering bigger returns. We saw that starkly last year, when government bonds in the US became the most attractive asset on the planet, because they were delivering a really risk-free 5.5%. It's gold for most people, right? You can't kind of argue with those narratives, I guess, is my view.
Yeah, it's certainly really interesting, right? And I think that going back to what you were saying around the price levels, people will always have their number, right? That they'll check out on. Like, I kind of look at this, and previously I had the view that, hey, as soon as it gets to a certain price where I could pay off my mortgages, sweet, I'm out, right? Like, that served this purpose. But as it actually begins to become apparent what seems to be happening here on a much bigger scale, you begin to increase the price that you would bail out at. And so there's this connection between how people have learned about Bitcoin and their continual learning about it, and the price rising that they would be willing to sell at. And so there's that going on, but I don't know how that ranks with how most people actually think. Like, most people still I feel like most people still actually think that Bitcoin is a speculative asset, which means that they will capitulate and dump, and fewer heads will own more coins as time goes on as a result. But what do you think? Like thinking ahead, do you think people will kind of bail too soon?
Oh, invariably. Like, I think Bitcoin is like all other assets, and it's one of those time in the markets outweighs timing the markets. And what that means is the longer you have it and hang on to it, the higher, and it's volatile, don't get me wrong, but the higher chance that you're going to get a bigger return. We see that with shares. If you owned Apple back in whenever it was, 1990, you're going to be doing pretty well. That's 30 years of holding an asset. You hold a house for 20 years, that 20 years holding an asset, you're going to see something way different than if you're turning it over every couple of years. So I think, I don't think crypto or Bitcoin is divorced from that. Like, it is an asset that in my opinion, you want to buy and hold for a while. In your window, your timing is your timing. It's different for everyone. I do agree that the longer you have it, the more your price shifts. Like, I joined after the market after the 2017 bull run, And back then 100 grand was farcical. It was just like, wow, and now that's, we're assuming we're going to blast past that in the next few months, sort of stuff, right? That's no one's worried about 100 grand anymore. So I agree that's that will change. And then I think that, people need to have a talk to someone such as yourself, Darcy, and work out where they are, stage of life, what their risk profile is, and what's material for them, if it's paying off their mortgage because they're getting closer to retirement, or it's hanging on for 10, 15 years because they're a young person and, they're unencumbered by other stresses in life, whatever it is. Like, I think everyone needs to have a little bit of a think about that. We do live in this world when you own cryptocurrency that there's a crypto market and then there's the rest, and you do have to balance what's going on in both of those. And people are hyper wealthy in crypto and really cash poor. And sometimes they might need to rebalance that as well, right? So it's part of the journey that everyone needs to think about and work through how what they own and how that works for them and where they want to be in their life, right?
Yeah, it's good, and that kind of is related to my next question, which is like, what is a reasonable rate of a return for one to assume? And I know you're not going to necessarily give me an answer, so don't worry about that, but I just know that it's remarkable that if you got in, say, 2012, maybe it was 8,000% rate of return. If it was the next cycle, it was 1,000, and then it's 100, and now it's kind of like 40. And I'm kind of thinking, well, hey, if we're mapping this out over, say, a 20-year time frame, we want to be realistic, but we kind of have to be quite conservative. And so lately, I've just been thinking, well, what is a reasonable rate of return? Do you have a view on this at all, Paul?
Look, I don't think about it that way. I do agree that the rate of return is declining over time, and so is the volatility. And my view is volatility has got a bad name in New Zealand investing circles.
Yeah.
Just from my view on volatility is there's more chance of upside as long as I hang on longer. And that, you ride out the waves as they come. And so I try desperately hard not to view volatility, not always, as a bad thing, I guess, is my view. In terms of, rate of return, like I think it's, given the programmatic scarcity, and there's no one with the ability to change that scarcity, that's another thing. I do think Bitcoin in particular has an attribute which means it should command higher yields. Like, if you just keep the demand curve roughly going the same way, I think it will continue to deliver quite high. I don't think it's alone in crypto. Like, I think Ethereum at the moment is deeply burning a lot of Ethereum at the moment because of its market dynamics. Like, it is at a deflationary asset at the same time. So I think there are a number of things out there that have that characteristic. I don't know if I could put a number on it because I don't look at that research that way, Darcy, but I do think it will command a premium, I guess, over. And like, when I say medium term, I'm thinking 10 years. That's my medium term. Long term would be 20 years, I guess, is my view on that. And so definitely over the medium term, it's a little hard to see how that dynamic might continue.
Yeah. And I think, like, when I'm talking to clients, I'm adjusting that based on what their time frame is that they're investing for. Because, I think the other complicating factor is that it feels like we're still at the very early stage in terms of adoption in a sense. And maybe there's a gap between that and like mass adoption. And maybe that's why it's really hard to understand where we're at. And in fact, maybe the rate of return actually increases as we get to that next stage of the bell curve, right?
Well, we're really bad at understanding exponential curves. As they just don't compute well in our brain. And so I tend to agree. If for your audience out there, like I said, wallets had increased by 33%. We know that there's roughly 500 million of them, which is a big number, but there's 8-9 billion people on the planet. So, we're not even at kind of 20% adoption globally of crypto. And so, what is mass adoption? I don't know. So, but it's more than that. I would argue probably 15-20% of the population globally or something like that getting to it. So I just think you're quite right. Like, we are still a little early in the adoption curve, and whether that adoption is being fueled by more familiar access, which is the ETFs, or people natively buying it, which works for large portions of the population where they don't have banking, they don't have share trading apps, they literally have a mobile phone with an app. I think we will continue to see adoption and growth, particularly if the asset keeps going up in value. Success begets success in that regard.
And so you mentioned the 30% increase in wallets. We can track the net inflows coming into these ETFs as well. How could investors or investors specifically in Bitcoin find the data to give them an overall picture of the demand for Bitcoin? Like, what kind of metrics would they be able to see that's publicly available?
The crypto industry is kind of at its genesis an open source industry. So there are a number of sites that you can go to and get free reports. June Analytics. I've got a report emailed me today from NYDG, who is a Bitcoin only fund. And there's a lot of detail in there talking to you about the inflows and the outflows of the ETFs and all that sort of stuff. The upside is it's freely available. The downside is you're probably going to have to go to a number of places to get it, right? Glassnode is another site that tracks, inflows into ETFs and volume on exchanges and all that sort of stuff. So there are a number of places that we talk about that. Easy Crypto puts out a weekly newsletter to its high value clients, and in that we kind of snapshot what's going on and, our opinion, what's going on that affects, the major parts of the ecosystem and the global economy. Again, we're trying to marry more of Real Vision, Rail Power stuff as well as crypto. We think those two things do play together. If you're seeing container shipping prices spike, guess what? That means inflation. Costs are going up. So costs are going up, that means less money to be spent. That's kind of the thinking there. That's why we track that sort of stuff for our newsletters. Again, there's plenty of sources around. If you can find trusted people on Twitter, and there are people who are out there, just Google it, trusted people on Twitter. There is a number of lists out there. Please visit. Don't just take it at face value, but there are people talking about, inflows and outflows into ETFs, what's going on in various large cap coins, and, tracking all of that sort of stuff. And again, you got to do your own research. You got to parse that information, come in and think about what it means, what's going on. Because ultimately it's one person's view yelling into a megaphone, and correlate it with other things. Put the same disciplines that you would put against the evaluation of a share. You wouldn't, as a financial advisor, say ape into Apple, without having a bit of a research around what's going on, what's going on with iPhone sales, all that sort of stuff. Is it a good time to buy? You have to look at what their announcements are and what's going on in their world, and make your own decisions. And so we would say, do your own research on that stuff as well.
I think that's kind of happens, right? Like over time, you might get attracted to the speculative nature of Bitcoin. You get excited, gives you that endorphin hit because it's so volatile, and you might get a couple of wins before you face ripped off, of course. But then eventually you migrate into this different stage, like what you're saying, where you are kind of taking in a variety of sources of information to understand the fundamental world, what's driving the price of Bitcoin. The cool thing about that is that it really extends quite well, I think, into traditional investing and understanding some of the dynamics that do drive the demand for Apple, for example, or just trying to understand the migration of technology through traditional finance, how that creates opportunities and risks as well. So it is great. I think Bitcoin is awesome, but like with your overall learning and what you surround yourself with, what are some of the go-tos, like say YouTube or Twitter? Is there anybody that you kind of want to give a shout out to in terms of?
Yeah. So I used to work with a guy called Josh Oshputz, and he is, in my opinion, one of the best, most rounded analysts out there. He uses a lot of tools. He looks at the macro a lot, and he has a long-term horizon. At Carpe Noctem, I would look him up. and he's a young guy who's done this for a long time, but his way of dispassionately analyzing a market is really powerful for me. And I would subscribe to NYDIG. If you're only interested in Bitcoin, they talk a lot about that. And then I would look at, what Raoul Paul and the Real Vision guys do. If you're coming from traditional finance, that they're going to put crypto into speak that makes sense to you.
Cool. And that the newsletter that you guys put out is awesome, especially over the last 12 months in particular. Like, it's one of the newsletters that I actually read. I get quite a few, but really good stuff in there. So thank you for putting that out. Before we finish up, a quick shout out to Easy Crypto. Thank you very much for sponsoring this podcast. But also, can you just give people a little bit of a lowdown on what Easy Crypto does? And I'll put a link to sign up, of course, into the show notes. But yeah, what does Easy Crypto do?
Well, look, so we're a business that helps you buy and sell your own cryptocurrency. So we are a broker. So we take in New Zealand dollars deposits, and we will send you crypto that you hang on to in your own wallet. It can be our wallet or one that you've chosen, and we will also help you sell it and get New Zealand dollars back into your bank account. And so having that bank account is a big part of why we're a bit different from the other crypto players. We've got 150 assets on our platform, all of the what we would call large caps through to some altcoins in there. And we designed to make it easy to get into our ecosystem. We have a piece of our website called The Hub, which is an educational resource to get you up to speed around what are wallets and how do they work and all that sort of stuff. So if you're really interested in getting started, start there. And our raison d'etre, our reason for being is to just, get people into this ecosystem. We think it is a challenging, disruptive technology, and we want people to experience it. And, even if you're a naysayer, please buy a little bit of crypto and understand how it works. There are some great parts to it. There's some bad parts to it. We acknowledge that, but, try it, have the experience, send some crypto around the world and understand that the fees are the fees, right? And they settle in instantly anytime. It's quite powerful when you get your head around it. It's the type of thing that you can't unsee when you've done it. And again, we're a regulated provider, so you will need to know your customer and sign up properly. We're going to do our best to keep you as safe as you can be in our ecosystem.
Awesome. Well, thank you very much for your time, Paul. We've covered a lot of ground in terms of the ETF, the Bitcoin halving cycle, impacts on price. I think those are all the things that are generally quite topical right now. And we are almost a week away from the halving at time of recording. So probably when this gets released, it will be imminent. And what are you expecting? Just to finish up, are you expecting kind of like a nothing burger, or are you expecting kind of like the year 2000, everything's just going to explode? What's going to happen?
Oh, look, my history with halving suggests it's a little bit like New Year's. Like, you go in thinking it's going to be exciting, but it's a little bit flat. And it's because everyone's expecting it to be exciting. And then after that, all the real excitement in terms of price and demand happens after the Bitcoin halving. That's my expectation this time around. There's normally a little bit more price volatility around a halving event, as people try to bet that it's going to go moonshots and all that sort of stuff. My prediction is more like year 2000, Christmas, New Year's Eve. We all thought something was going to happen, and it turned out to be just another night, right? That's my kind of operating model going in.
Cool. Awesome. All right. Well, we'll leave it there. Thank you again, Paul Quickenden from Easy Crypto. Cheers.
All right. Thank you. Nice to talk.